Every single day, millions of people log into their brokerage accounts and place bets on the stock market, and 95% of them will lose their money. They treat the market exactly like a casino, guessing on direction and praying for a payout amid the violent swings. But the market isn't actively trying to beat you. It doesn't even know you exist. Most retail traders beat themselves. They dive straight into buying and selling without spending a single day understanding how the machine actually works. They build a house with absolutely no foundation. To survive, you need a rigid blueprint. This is a 180-day, 6-phase master plan, refined over decades of market action, designed to take you from a complete beginner to a consistently profitable trader. Memorizing 100 different chart patterns won't keep an account alive. A professional edge comes from mastering human psychology and strict risk management, the invisible factors that decide whether a trader survives their first year. Completing this grueling 6-month evolution requires dismantling every instinctive habit that makes retail traders lose. You are learning to become a disciplined architect of your own trades, rather than an impulsive gambler. The first 20 days are entirely dedicated to the foundation. Before you ever place a trade, you have to understand the structural reality of the exchange you're operating on, like the National Stock Exchange, and identify exactly who you are trading against, from massive institutions to local retail participants. You also need to track the macroeconomic pillars that move billions of dollars overnight. That means paying close attention to national budget announcements and the specific interest rate decisions handed down by the Reserve Bank of India. Once you understand the macro environment, Phase 2 covers days 21 through 60. This is where you learn to read the charts. The governing philosophy here is simple. Price is truth. Everything else is just noise. This diagram shows a Japanese candlestick. It is the primary visual language the market uses to communicate. By tracking the open, high, low, and close over a specific time frame, you see a permanent footprint of exactly who won the battle between buyers and sellers. When you string dozens of these candles together, you start to spot specific psychological levels. We can draw horizontal lines across the repeated peaks and troughs to identify support and resistance, the invisible barriers where major buyers and sellers reliably step in. Notice how we haven't mentioned a single complex technical indicator yet. Moving averages and RSI are just trailing mathematical tools. They react to what the market has already done. Mastering raw price action is the only reliable way to read what the market is doing right now. By day 61, you enter Phase 3. You have a solid base, and it is time to build your specific strategy arsenal. We focus only on tested methods deployed for distinct market conditions. This chart demonstrates the opening range breakout, or ORB strategy. We isolate the absolute high and low of the first 5 minutes of the trading day. When the price breaks above that initial ceiling, we follow the institutional momentum for a fast, disciplined entry. If you decide to transition into options trading, the rules change. Options are mathematically complex contracts. Generating consistent income here requires understanding variables like theta decay and delta, known as the Greeks, rather than simply guessing if a stock will go up or down. But knowing exactly when to buy is only half the equation. You can memorize every breakout pattern and option spread, but even the most perfectly timed entry will quickly wipe out your entire account if you execute it without a protective shield. That brings us to Phase 4 and Phase 5. This is the ultimate differentiator. I have seen brilliant chart analysts go completely broke, and I have seen highly average chart readers become incredibly wealthy. The only difference is strict risk management. This diagram shows the math of profitability. You never risk more than 1 to 2% of your total capital on any single trade. And you structure your targets to enforce a minimum 1 to 2 risk-to-reward ratio. You risk $1 to make 2. Then comes the hardest part of the master plan, your own brain. We are biologically wired to hold on to losing trades out of hope, and to buy at the absolute top out of fear of missing out. You are the ultimate enemy in the market. To survive Phase 5, you have to completely detach from the concept of money. You stop looking at your screen and seeing rupees or dollars. You start tracking your trades entirely in terms of defined risk units. Ruthlessly copying your downside risk and managing your own emotional spikes is the only mathematical way to survive your inevitable losing streaks. That is how you stay in the game long enough for your edge to compound. Finally, on day 151, you enter phase 6. You transition to trading real money. The mandate here is simple: the smallest position size possible, paired with massive discipline. You adopt the rigid daily routine of a professional. By 7 a.m., you are scanning global markets, checking index futures, and pulling macroeconomic data long before the opening bell rings. After the market closes, you conduct a brutally honest review of your actions. Your trade journal is your most important asset. It tracks your emotional state as closely as your actual entries and exits. Live trading requires a rigid internal code. The most critical realization is that the market is always right, moving wherever liquidity dictates. Any losses are the result of the trader's assumptions, not a failure of the market itself. When you are wrong, you cut your losses immediately. When you are right, you let the profits run to your target. And you never, under any circumstances, average down by buying more of a losing position. Trading shouldn't be thrilling. A boring, highly repetitive system built on steady execution will mathematically outperform a trader swinging for massive home runs. Executing a disciplined system every single day converts the chaos of the market into a manageable risk. Completing this 180-day evolution puts the mathematical odds in your favor, turning a game of chance into a professional practice.